All right. Good morning, everybody. Getting a little bit of a dead cat bounce this morning. Now, as usual, the first thing we want to do every morning is kind of get an idea of what happened while we were asleep. Very often, the day that we have bleeds out around the world, and then they have a day that is respondent on what happened in our market, or vice versa. They'll have a day and it carries over into our market. And what you'll often find is whatever was doing good in Asia or whatever was doing good in Europe will be the same sectors that carry over into today. So if you see automotive doing good or REITs, the EV market, finance, you'll often see it carried over. So you really want to have a little bit of an idea of what happened in the overnight hours. And there's a few different places to get this information without having a subscription to something expensive. Because of course, if you've got subscriptions to some of the major brands out there, you'll have this kind of insight. Um, the problem that I've seen is newer traders who are not yet successful or are consistently successful to bring in money don't really want to spend money on a product to help them make money. I mean, I get it, right? So trying to keep the costs down. Koifin is one of those places where you can get global news. You get a little insight from here from around the world. And then, of course, top news at the same time. You can get some corporate events. I'm logged into this, but I'm logged in on a free account. I don't have like a premium account here. This thing used to be free and it was my go to all the time. Now that it's not completely free, I just use it for this in the morning. So, looking around, you want to kind of get an idea of what happened and if anything important is going on that is carrying over, which a lot of times it's not, but you don't know, right? So you get up in the morning, check the news. FX Street is another one that is free. You don't have to have an account here. If you do open an account here, be very careful with the email address. They will bomb you with emails. It's really annoying. At 10 a.m. today, we got the Michigan consumer sentiment. And the reason that I like coming to FX Street is because you don't always know which of the economic events that are coming in today are expected to be impactful. Now, sometimes they're going to get it wrong because something that we think won't be impactful suddenly is, or something that we think will be impactful comes out and it turns out to be a dud and nothing happens. So they're not promising that something big is going to happen. But what they are looking at is consistently kind of looking back and asking the question, when the Michigan Consumer Sentiment Index news comes out, does it usually rock the market in some way? And based on historical precedents, it will color this box there, a shade of different colors of orange into red. And then, as you can see with these other boxes, sometimes the shading is a really light color, right? So there's no set way of doing that. It's not guaranteeing that it's always going to be impactful, right? So just kind of keep that in mind. But having said that, FX Street is really good about showing you what you could anticipate on the day. Yeah, oh, come on, FX. And then of course just don't maximize like I did and you'll be all right. There it goes. So Thinkorswim has the same thing, right? You can come here, you look at the calendar, but it doesn't give you the idea of how impactful any of these reports are going to be. This is all we have on the agenda today, by the way. So once we're done with these, we're done. By 10 a.m., Whatever econ we're going to get has already been given. And then it's just going to be who's out there chipping their teeth. And we do have some Fed speakers speaking today. Right. So at 6 a.m., at 7, 12, and 1. So I posted those in the main chat. You can see them in the Discord. I'll post them onto the message board for all of you out there. So we do have those, but that's it, right? We get done with that and we're good to go. So a little bit of econ and then some Fed speakers. I've heard a lot of language about oversold, oversold, oversold. Be very careful with that language. The market does not owe you a bump to the upside. Try to find another way to discuss the same concept, right? Like linear regression, mean reversion, stepping too far away from the center. Those are really good ways to identify, have we gone too far and could we maybe anticipate some sort of flip or reversal or pullback, dead cat bounce. And from that point of view, what I see in the like in the CMT manual or a lot of technical analysis use is either the 10 period moving average or the 20 period moving average. I like the 10. I have an IBD account, and IBD uses the 10 week. So I kind of got really familiar with using the 10 all the time. I also often use the 10 from the daily, and I use it enough that I built an indicator for it. Basically, just like what it sounds, distance from the 10. Talking about a 10 week, and we're talking about the 10-day. What you'll find is markets that get, quote, too far away from their 10 will pause there or reverse and come back towards the 10. The 10 is like a gravity point. On a 1 year chart, we're looking at the ES. We're looking at the 10 week in the top one here with all this orange and red. We hit 6.57 yesterday. So we are 6.57% away from the 10 week moving average. That's the most extreme we've been from the 10 to the downside in an entire year. Now I could set this on a higher time frame and look farther back, but who cares, right? We just want to know, are we really far away from that 10? Yes. Are we beyond the norm? Yes. Is it likely going to reverse today? Yes. But reverse doesn't necessarily mean that we're going to go up. We could just quit falling. That would reverse what we've been doing, which was falling. So an inside day today would not be out of line at all. And it kind of fits into the idea that when we get too far away from the 10, we pause there and we let the 10 catch up. If you have ever dealt with stockcharts.com, they often talk about a damaged market and then seeing a market heal or giving it time to heal. And that's often what they're talking about is something went parabolic or there was a catalyst and then the market needs to pause there and hang out and regroup and let its moving averages reset. All right. So it really just depends on where you're getting your technicals from, which of course makes everything confusing for a newer trader because then the language shifts a little bit or the words are a little different and they just think that they get confused. It's easy to get confused when different places refer to these things in different ways. But we're also looking at distance from a daily moving average. And again, I'm on a 1 year daily chart. We hit the extremes earlier, a few days ago, but at our current location, we're not very far away from the 10 on the daily. And that's really dangerous and really important to point out. If we're talking about could this market continue to go to the downside because we have not yet traveled too far from the 10, this is telling us that we are really close to the 10 still and that there's a long ways we could fall before being considered oversold, which I hate that phrase. You really want to get away from that. Oversold just seems to imply that the market owes you something or that we've gone too far. And you better find another way to quantify that, right? Otherwise, it gives you the impression that it's a buy spot. So I just loaded the 10. And since I'm on the daily, that's the daily 10. And you can see we're not really far away from it. If you look back at history, there have been times when we really got far away from the 10. And just like in those periods where we got really far away, you can see how the market reacted and it whipped back the other direction, very much like a bungee cord hitting the edges of its stretchiness. We're nowhere close to that distance. The edges have been around 4 to 4.5%, and we're sitting at 1.8%. So we could fall hard and fast a long ways down, plenty of room to the downside before we've gone too far. That's why perspective matters, right? These indicators are in the Discord, by the way. I don't sell the things that I make, so you can find them there. Although I keep getting asked to sell them, so eventually maybe they're probably going to be sold, but I don't like the idea. I don't like it. We just give the indicators away, use them to make money, right? No, not make indicators to make money. All right. So looking at the ES, one of three things that we can do: maintain the range, break to the upside, break to the downside. When we're talking about breaking to the upside, you have to already recognize that we've had a breakout on the day, right? We are already outside of yesterday's, or we're outside of yesterday's range. No, we're still inside. So what is this ADR breakout? Well, it's saying we're outside of the ADR. I think that label may be wrong, huh? Because if we were outside of the ADR, we would be up 2.8, and we're only up 1.2. So that doesn't quite fit. I think that label is measuring the wrong thing somewhere. So forget the label. Definitely keep your eye on the fact that we have a market maker move today. This is giving you an additional expected move on the day. On any given day, we have a known distance that a market is supposed to move or should move within its expected move accuracy of 70%. It's a standard deviation. That standard deviation calculation of expected move is a square root of time formula mixed in with some other voodoo. When you can take an additional market maker move and add it to your daily market maker move or your daily expected move, then you step beyond the ADR. All right. So where do we get these numbers? Go to the trade tab and look at the top. There's market maker move. Now, if a market doesn't have market maker move, it won't show up. I've had people say, "How did you turn that on?" I didn't. If there was no market maker move, you wouldn't see MMM here. Right. So um, they really need to rethink that, right? If there's no MMM, the little MMM should still show, but maybe put a zero next to it. That way it's always there. And then there either is a number or there's not. But I don't make the rules with Thinkorswim. I'm just pointing it out. All right. So we got a 0 day today. The expected move on this 0 day is $56. Then you've got an additional $36, right? So 50 and 30 is 80, 6 and 6 is 12, that's 92. That's a $92 expected move higher or lower than our current location right this second. And that is only for today. Yesterday was the bottom of yesterday. Yesterday was not the bottom of this downward move. And I hope that you don't try to go out and buy a bunch of stuff thinking we've hit the bottom. If you do, be prepared to hold it a long time with pain, right? Preferably not with options because they're just going to decay on you. Which does bring us to another point. Guys, we're not at the bottom. We're we have not seen capitulation. We are not done. This is by no means the end of things, and you better be prepared for a lot more pain to come. For the last 10 years, we've seen the markets take downturns and then recover from those downturns. Part of the recovery was because the Fed came in and would inject it with a bunch of adrenaline. They can't do that this time because they're trying to solve this whole situation with inflation. So they cannot pump adrenaline into this market. They have to continue to do everything they can to kill this market because it's economy based this time. You have to separate candles, which is market, from economy, right? So we have a really bad situation and they can't fix it. So, one thing that you could do to see what this looks like is to go back in history to other periods in time where they could not fix it. They could not pump liquidity into the market and give it an injection or a booster. That would be the '07-'08 housing crisis or the dot-com bubble of 2000. Go back and look at those periods of history where we seen the market cut in half plus some, and it took years to fall. And then it took even more years to come back out of that mess. They always say that history doesn't repeat, but it sure does rhyme. Well, if you want to get a good idea of what kind of market we're going to be dealing with and what kind of history we have behind us that can offer some insight, here's the '07-'08 housing crisis. Years to the downside, and then even more years back out, right? So a long ways to go before we're done, and a lot more to deal with before we start coming back out again. Here's the 2000 dot-com situation. The market was dead and it didn't even know it. It took a year in a topping pattern. And then it took 2.5 years in a falling pattern. And look at these rallies. You imagine how many people said, oh, that's the bottom. No, wait, no, 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 just kidding. That's the bottom. No, wait, no, 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 it's over here. That's the bottom. Uh-huh. It was the bottom for that week. It was the bottom for that month. Heck, it might have even been the bottom for that year, but it wasn't done. Take the same thing and put it into the 2008 housing crisis, and you get another example of where the Fed could not come in and save the bacon. In fact, the Fed right now is doing everything it can to kill this market, to take every one of you buy the dip people who haven't learned your lesson yet and continue to force pain on you until you finally get the hint. Quit buying the dip. And then we still need capitulation, and we're not going to see that yet anytime soon either, right? So '07, '08, finally bottoming out in '09, and then years of work to come back out again. Right now, we're not even back down to pre-COVID levels. We have to at least have an expectation that we're going to go there. And if I'm wrong, hey, I will happily be wrong. Halfway through the COVID fall has been my target. It is still my target. That's target number 2. Target 1, 35. Target 2, midway through the COVID low. Target 3, the COVID low. History will tell us, right? So for today, we can stay range bound. We can break to the upside. We can break to the downside. It always is one of those 3 choices. So for the sideways discussion, realize already that we are outside of the RTH from yesterday, right? So we're inside day breakout. From that, we can start to focus on institutional pivot points. We have our own Globex high, which we're continuing to push through at the moment, setting new highs. We have the open of yesterday, which is not too far over our head. Actually, that's the open of Wednesday. So 39.85 is another pivot point we got to deal with over our head. Should we get through that one, RTH high of Wednesday, and I think we would be at the edges of our ADR at that point. So right now we're up 1.25. We'll just add another 2.5 to this to see what our current ADR would be. Oh yeah, now plenty of room. Okay, so we can get above all of this and actually get back above 40.75. So if we were to get a full-on rally today and match our current ADR number, it would be up into this zone here. And in the current violence, this is our right now number. So it's well within our distance, especially when you add the fact that we have an additional almost 1% market maker move, right? A 2.8 ADR may seem very far away from just sitting here drawing it. I know how far away that looks, and you may be thinking, come on, man, you're reaching. That's really far away. I'm being conservative, right? I did not bring in the additional market maker move. So if we do go from our current location, which is up 1.2, and we add 2.6 to that, that would put us here. And I'll just go ahead and add another 1% because of the market maker move. That's three and a half, right? I'll even shave off a little bit, 3.5. It's 41.18. There's a cog line at 41.11. I'd call that for the top side, 41.11 cog. So when we talk about how far a market could go on a day-to-day basis, we need to know what the numbers are, right? And that's our numbers right there. We could travel that far today and the market would not consider that an extreme move. You got to have that perspective, right? Do I think we're going to make a move that far today? No, I don't. But we could, and it wouldn't be considered extreme. These morning briefings, we go through this routine every day, right? It's a part of the process. Every day we do this process. And I've made this kind of comment before. When it comes to statistics and probabilities, we're told not to use words like impossible. Instead, if we think something is impossible, we use words like improbable. I find it improbable that we're going to go that far. And yet, I've used those words before and have been proven wrong. This is a part of our measurement for today, and it is not an unrealistic number. That's a conservative, bullish target. So that's our upside play. We talked about the range. If we're going to deal with or stay in the range, then we're going to come back inside of yesterday's price action, probably rest somewhere around the Globex open, the RTH open, or find some support around yesterday's low, and we'll maintain that range through the day. It wouldn't be unrealistic to have that sort of assumption. Look at Tuesday and Wednesday, just inside days, right? One day inside the previous day. And you could even add Monday to that. So Monday, Tuesday, Wednesday. Sure, we wicked outside the edges, right? We went a little higher or a little lower, but we mostly maintained the inside day. Well, we dropped lower than that. And we have this very simple expectation that we could maintain inside of yesterday's range, or we could just come back inside of the week's range. So think about that. If we mark Sunday night Globex to yesterday's low, there's our range for the week. We would have to get all the way outside of that before we would even be advancing on the week, right? There's something called a weekly floor pivot. It uses the floor pivot calculation, but instead of daily, it uses weekly. There are a few really popular traders out there that use the weekly pivot as a perspective of where we are in the market. Are we above the weekly or below the weekly pivot? Are we moving towards that pivot or away from the pivot? It's a pretty interesting concept. If you've never tried it, it's worth looking into. Right now, if you look on Thinkorswim, it doesn't have something called quote floor pivots, but it does have pivot points. And if you hit the little circle there and read what it tells you, this actually is a floor pivot indicator, right? So just add pivot points. It's the same thing. Go in and set that to a week, and you can see where the weekly pivots are. Now, I personally don't like this one because it shows each day with its own pivot point. That seems odd to me. I would want one that spans the entire week from Monday to Friday with one weekly number. So I don't like that one, but it is the one that's there, right? Um, bum, 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 bum. Do mine. I like that better. So mine shows the weekly pivot up here, spans for the whole week, Monday, Tuesday, Wednesday, Thursday, and into today. We are below the weekly pivot, but we are moving back towards the pivot. Yeah. Yeah. All right. Wasn't much of a surprise. We already knew we were below the pivot. And then the third scenario would be that we actually break below yesterday's low and continue our move to the downside. We've got an ADR of 2.8. We are up 1.3. So let's first take back our 1.3. That gets us flat. And then from that, we'll put an additional 2.8 on here. So what we're tying into is the close of 4 o'clock yesterday. I don't have a 4 o'clock close. It'd basically be the right there. So if we put a 2.8 from that, lines us right back up with yesterday's target, which is nice. I don't have to move any lines. 38.18. Now remember, that does not bring in the additional market maker move for the day. If we wanted to bring that in, then we would be down at 3.7. So 37.81. And that would not be considered an outsized move. It would be well within our rights or well within our boundaries, well within our movements. I'm going to just keep my negative ADR target from yesterday since it lines up with our current ADR of today. We'll just expand the line another day. Simple, simple. All right. So when we're talking about these pivot points, we always want to validate and identify and quantify the accuracy of the lines and anything that we can bring in that may assist us. The point of control is a long ways away, and so is the anchored VWAP. But we are back inside the box, negligibly, but we are back, right? We just peeked our head inside the box. But that looks like a little bit of a blow off top signal. Uh, Very likely going to just pull right back against it again. Either way, when we're outside the box, we expect to see price come back inside the box. We want to look at the volume profile and see if there is any expectation of resistance that we need to be concerned about. There is some volume resistance at 40.17. that spans down to around 4011, the cog line of COG. So that will be an entire zone of resistance in volume. But should we get past that zone, we start to get into this shallow area. And price can move through the shallow areas relatively quick. Good morning, Nadine. Hope you're ready for a Friday. We also want to take a look at the 5-day, 5-minute volume profile. Same concept, same idea. We do have an untouched point of control from yesterday below us at 3,900. Should we get near that, it will become gravity, and we will expect a reaction or a response from the market. We have an untouched point of control from Wednesday, still over our head, around the 4011 or the 4013 area. Should we get near it, it will become gravity. We will aim for it in the target. And when we get to it, we expect to see a reaction in price. There is another one really far away at 4111, up near our COG, our market maker move, and our ADR measurement. If we get that close to our original target, we're very likely going to go ahead and go to that gravity point way up there, right? Or that untouched point of control. So just kind of keep that in mind. If we already have traveled that far, we're very likely going to finish the move and get up to that point of control. That point of control would be 4119 or 4120-ish. It's worth noting the moves that we had yesterday and how absolutely awesome that afternoon rally was. So we've been trying to work more on calling out intraday trades to provide opportunities for the futures. They move fast, so it's hard to just sit in there and say I'm getting in here with this many contracts. What we've been doing instead is pointing out where we're headed, what's our targets, and then let you on your own figure out how you're going to get in there and with how many contracts. For that, we have to have a bias and a direction. As we got into 3 o'clock yesterday, I did what I normally do. I come in and remind everybody about where we are and the possibilities or the opportunities that arise due to our current location and what a reversal signal would look like. And then we got it. And we started to make that move back up and out. Hopefully, you got a piece of that. That was pretty awesome. There was some earlier call outs, not as much as we had the day before, where we spent quite a bit in time in chat calling out all of this run back to the downside with signposts and targets right on back down the run. Right? Don't know how much of the day I'm going to be in the office because it's Friday and I'm day done. I don't need to trade today at this point. I think we're going to run to town and have a little bit of fun, but I'll be in here for some of the move. So likely be doing a little bit of calling out. I do have live stream today at the Bullish Bears from 9:30 to or from 9:15 to 10:30. Of course, I tend to stream until 11. But after that, I don't know how much more I'll be in the office after that. Notice the VIX and the dollar are disconnected. Hey, Wayne, how you doing, buddy? It's interesting that the dollar is disconnected from the VIX because we've been using the dollar as our VIX gauge since the VIX has been so unresponsive to the kind of moves we've seen. If you're newer and you're thinking, well, the VIX sure has been moving around, it has, but we're in some pretty oversold, and I hate that word, but we got to use it. We're in some pretty oversold markets. Where's the fear? Where's the pain? Where's the VIX? It's not doing its job. And I think it's just because we've seen this movie before, right? Everybody's becoming numb to this, and they've all by now are carrying more than enough insurance that nobody's buying any more insurance because at some point, how much more insurance could you get? especially with the idea that insurance is not free, even for us, right? So when we buy hedges or we're carrying hedges, it's just money spent. Just like your house insurance, you never want that money back because that means something happened to your house horribly bad and you have to collect insurance on it. Well, I'd rather not have my house destroyed just to get my money back. Same thing with a hedge. When we put hedges on, we're basically taking a lighter and burning money, hoping we never get the money back. Because the only way we would get our money back is if the market crashes. So once you've bought all the insurance that you're going to buy, there's not much more to buy. And every institutional trader out there, even the ones that are the slowest to begin hedging, have by now started their hedges. So we don't see a lot of the VIX being traded. We're not seeing that response in the market. And that is screwing up a lot of things. It's screwing up our options trades. It's screwing up just a lot of things. So what do we do when the VIX isn't working the way it's supposed to? We start focusing on the dollar. The dollar not only can recognize our own risk here in the US, but it becomes a proxy gauge for risk around the world. It's like a global fear gauge. Now, the dollar is not always that way, and I've gone through and I've talked about that before. Don't want to circle back through it today. There are times in history where seeing the dollar rip is a positive thing for the market. Then there's times when seeing it go up is a bad thing for the market. And this is not the US greenback dollar, right? This is the dollar index. There's a big distinction between those two. Thought we were going to see a little bit of recovery in the bonds, and that didn't happen. So we want to keep our eye on these two markets today. Remember that the S&P has financials and the NASDAQ 100 does not. So with this move in the dollar and the move in the VIX or the move in the bonds, keep your eye on the dollar today. Keep your eye on the financials, XLF and KRE. You want to keep your eye on those two because if you're going to see an S&P rally or if you're going to see a NASDAQ rally, stocks, the ones, the FANGs and everything rallying up, generally speaking, you got to have one or two sectors, at least one of these two sectors, finance or tech. Well, if it does split the line that way and give us only finance or only tech, then you're likely going to see a divergence in the S&P or the NASDAQ. Remember, a correlated market state is a stronger market state. It's a more dangerous market state. So if tech and finance rally, then S&P and NASDAQ rallies, then 95% of all the markets out there connected to those two indexes are going to rally. On a day like that is where we want to activate our alpha protocols, right? Either to the upside or the downside. When you have a highly correlated market state and 99 out of 100 names are all doing the same thing, don't try to go in and be a stock picker. You can literally trade every name on your stock list, right? Aim for like a 35 or a 40 delta and buy everything. Buy puts and everything or buy calls and everything at that 35, 45 delta and just run it, right? It's what I came up with the alpha protocol because it's what the algos do. Well, why can't we do what they do, right? As long as we have the capital for it. Make your own protocol list. If you were to trade mine and maybe I have names in here that you would find uncomfortable because of their size or value, then it wouldn't do you any good, right? I've got Amazon in here and Tesla and Google. Those are expensive options to trade. Maybe a 45 delta option in Google is more than you're willing to spend. You need your own list, right? Make the list a part of names that are high up in their sector ranking, right? So if I say finance, XLF, what are the top 5 names in XLF from left to right, right? Like JP Morgan, Bank of America, Wells Fargo. And then on the next line, Morgan Stanley, Goldman Sachs, Citigroup, right? So make up your list, be prepared for a very highly correlated market state and just literally trade the list. For the ones that don't follow through, you'll know really quick and you can kill those trades off. You don't have to hold them. Another thing to add to that, if you find a market that has been doing good in the last 3 or 4 days, today it's likely not going to do good, right? If we're going to see a capital rotation today and a reversion of the mean from the S&P and the NASDAQ suddenly moving to the upside, Anything that had already been doing good for the last few days and making a move up while we've been going down is now very likely going to go down when we're going up. Capital rotation 101, right? So if any name on your list happens to be a name that has been moving inverted of the market, don't put it in your alpha protocol list right now. It is also a rare situation, or should be a rare situation, when you would actually activate the protocol, because it's very rare that we would see 95, 97, 99 names moving in the same direction. And yet, because we're in a downturn market, right? We're in all of this serious negativity. These are the times when we get highly correlated markets. So we will see more of these 95 and 99% ADR days, or advanced decline days. There are some really good research papers, by the way, if you want to read more about this stuff. It's where I learn a lot of this stuff because I'm a little bit of a nerd and it's my jam. Google is Google. Everybody knows Google, but there's another Google called Google Scholar. This Google is case law and articles that are peer reviewed. It's like college library material. So rather than just some BS article written by a reporter who was paid with bias, these are all peer reviewed and argued. They have to be fact checked, background based, solid, legitimate articles, which gives you references to every one of their data points. They can't just make random claims to crap without backing it up with facts. And you can find some absolutely amazing material in here. And just because it's Google, you can search and find that amazing material. Just about anything you want. Dark pools, gamma, highly correlated market states in a bear market. You name it, it's in here. All you got to do, start working your way through it. Careful, you'll fall down the rabbit hole, burn your whole weekend reading like a nerd like me, hanging out in the library, and blink and it's Monday. But I kind of like it. So to help with the sectors, I built these grids that look like this. You have your sector in the upper left corner, and then the names that make up that sector. At the time, this was their market cap weight. So, in order from left to right, how much impact their names had in that sector. Now, these charts are kind of old. JP Morgan may not be in front of Bank of America anymore, or Wells Fargo may not be the farthest one on the right. Maybe it's the first one now. But even if the order of them isn't exactly perfectly right, the names that are in here are right. So if you was to go and research XLF for an example, you would find that these are the top weighed names in the XLF, or at least they were at the time I made them. So if I see it's a day where the XLF is doing good, I want to go in here and ask which one of these names are doing it. Is it one really big name, or are they all doing it? And if they are all doing it, which one isn't doing it? Can I find one that maybe hasn't begun to make the move yet? Can I find one that is running contrary to the play? Well, if you've done it for a while and you do what I do often enough, you'll start to realize that within the XLF, you have these little niches or peer groups. JP Morgan, Bank of America, and Wells Fargo tend to all hang out together, and their charts very often look exactly the same. While in the same grouping, Morgan Stanley, Goldman Sachs, and Citigroup, their charts very often look exactly the same. And that through the day, the moves are perfectly aligned. When they don't, and you can see how yesterday Morgan Stanley and Goldman Sachs had very, very similar charts, and Citi didn't. So when they don't, things start to stand out. You want to start looking for divergence within those. Did this one fail to make a higher high like these two did? Yep. Did it begin to fall first before these two did? Yep. Citi was leading the way and these two were playing catch up afterwards. Same thing when you're doing a peer group like Wells Fargo, Bank of America, JP Morgan. Their charts are very, very often exactly the same, identical charts. When one of these three gets out of line, it's a heads up. It's beginning to do something that the others aren't doing. First, check for news, make sure that nothing is driving it out of the way. But if there's no news connected to it, it's leading the pack between those three. And the leadership can change through the day. This is just one symbol, right? XLF. But there's KRE. And KRE is regional banks. And it also offers opportunity or insider perspective within the financials on an intraday basis. But we're not done. I mean, we can go in and look at insurance, which is also another part of financials. We can look at credit cards. There's too many paths to take, right? You can, again, fall right down the rabbit hole. So just looking at the sectors themselves, KRE, XLF, can get you pointed in the right direction. But when we lean into something and we say, oh, look, tech is up today. What tech? Apple, Microsoft, Visa, Nvidia, PayPal, MasterCard, Intel, Adobe. Okay, that provides some insight, but half of these are FANG names: Apple, Microsoft, Nvidia, right? So we can watch the FANGs, or at least the MOTs, the monsters of tech. Just looking at XLK alone doesn't provide enough insight. There is IGV, which is like an expanded tech ETF. You'll notice some of the same names and yet some other names in there, right? Adobe, we already mentioned, Microsoft as well. But now we've got Now, Activision, Zoom, Oracle, Salesforce. So when it comes to quote tech or finance or energy, you can use that broad blanket statement and the really big ETF, or you can get down and dirty with it and start hunting through each of these names. I mentioned I've shared these charts. They're on the Discord, right? So if you go down and look through the trader's resource zone, there's custom charts. All of these are in there. So you can go in and just download the or import the link and then name it something so you know what the heck it is, right? I just use the letters of the main ETF so that you can go to communications or energy or finance, whatever it is, right? On a day like this, you don't necessarily need the sectors, but they're a nice guide because if we're going to rally and see a high correlated market, then 8 out of 10 or 9 out of 10 names are all going to do the same thing today. Now, you could choose to target the names that aren't doing what everything else is doing. I kind of like that. It works reasonably well. Or you could go in and just pick the top, strongest, healthiest names out of that list that is doing good and trade those. And to get to that, it would be focusing on the sectors and the names within those sectors. Simple enough. That's not what I'm looking for. This is what I'm looking for. So in the morning on a normal day, we want to be able to ask that question: how many sectors are up this morning and how much are they up? Well, we can see that Bitcoin's trying to do a little bit of recovery, +7. That's 7.25%. Cloud computing is looking pretty good this morning. Semiconductors as well. So those are the leading sectors that we could focus on. But then we've also got energy up over 2%. The Qs are up over 2%. Tech's right behind it, the XLK. Emerging markets, which what we use for a perspective of global risk participation or a risk on in the global market, 1.6% this morning. So that's looking really good too. Another form of energy, XOP, not quite at 1.5%, but darn close. And then it just really starts to drop off from there. On mornings like this, it's often worth just kind of asking the question, what's not up this morning? Well, KBE is not up this morning, right? So this is a banking ETF. Now it may be slightly down because of the way that TrendSpider records things. If it moved last night after hours, but has not yet moved this morning, then it could just still be showing us that minus 22% from the after hours trading without ever having seen any trading happen this morning. So that could be why the finance is still down, looking at it from that perspective. And then how far something is down means a lot. If it's or up, right? When I'm looking at change percent in the morning before the market opens, it needs to be at least 0.5%, or it's not going to be a part of something I even want to consider. So from that perspective, gold is down more than 0.5%. Bonds are down more than 0.5%. And then we start getting into things like the triple leveraged, uh, 3x, 4x, or not 4. Your triple leveraged and your double leveraged products are down this morning, and industrials are down. Now, we've talked about those old school legacy sectors, but those don't really do justice to the kind of world we live in now, where we need these specialized sectors. Things like crypto. This one little crypto ETF called BITO, I don't really feel that it provides enough input. I want to kind of know what in there is doing good. This crypto list is the names that make up the crypto futures for the Smalls Exchange. I opened up the exchange, looked at the weights inside of it, and these were the names that made up that futures market. So I thought, well, if I'm going to make my own sector to represent, you know, crypto, that would be a good way to go. And we can see the names on this list; they're all doing really good, except for a few of the odd little ETF names in there, like KOIN, BLCN. So there are a few that aren't doing well, but for the most part, everything in there is up. Things like MSTR up over 14, nearly 15%. Coin over 14%, right? Mara nearly 10%. My old friend Riot, 9%. We may come back inside the belt today. So crypto is looking really good. If we get a change in sentiment today, this would be my targeted perspective. I'd go in and hammer this thing right back down into the dirt. It actually sounds like a good game plan. So looking for the S&P or the NASDAQ to give up the ghost, flip the script, and start heading to the downside. Should they do that, I'm going to hammer crypto right into the ground with it. What else on here that we want to look at? So breaking crypto out and looking at it on its own, I find it really valuable to do so. But EV is another one. The EV market really should have a sector that we can lean into, right? So these EV names do have some old school legacy stuff like Ford and GM, but then it also has the newer stuff like Lucid and Ride, uh, Neo, Tesla, obviously, Rivian, XPEV. Everything is either up this morning in that sector or are flat. And some of these names are up significantly. You can add this to the beatdown list, right? If it's going to be one of those mornings where we get a head fake and this S&P NASDAQ starts to roll over and dump, everything that's up the most is going to be the ones I'm going to target to slam back down into the dirt. WWE style. The pot stocks are always fun to play and oddly enough tend to do their own thing. They don't really give a damn what the rest of the market is doing, which is kind of refreshing a little bit, right? Of course, when you get a situation like COVID and everything was down, even crypto and pot and everything. So you won't find that pot stays divergent from the market. It does get swept up. The old phrase, a rising tide lifts all boats, or that, can go in reverse too. When the tide goes out, everything falls. So from that point of view, you can't expect something like pot to buck the line forever, but they're up quite a bit this morning. Few names in there that aren't, maybe a little flat, and then UVV is down nearly 1%. But otherwise, things are looking really good in the pot sector. These are fun to play because they're so cheap. Some of these have some really good options too. Nice liquidity, easy to get in and out, great for small accounts. And for their size, these suckers can move, right? So they're worth keeping an eye on, or at least considering for some opportunity. I'm not seeing enough out of energy, not at least not using that ETF, the names that would make it up. If I'm going to look for opportunities to beat something down that's already ran too far, these energy names haven't even breached 3% yet. So I'll pass on that. That's what I got for you guys. We'll save the rest for large caps or for the live stream in the main chat room. Should start at around 9:15. I'll see y'all there.